What actually is Stropro? If you want to give a rundown just of the company itself.
So Stropro, like effectively what we do is we allow people to express a market view within the construct of a structured product. And structured products are massive globally. It's upwards of a $7 trillion industry, and it's really shaping the way equity markets move at the moment. In Australia and New Zealand, it's relatively nascent. Think less than a $30 billion market. So Stropro was founded to kind of bridge that gap and make the structured products realm more accessible, bringing, the wealthy Australian audience up to speed with our global counterparts. So, that was the real genesis which Anto and Ben, CEO and CIO, had when they were working at Citibank back in the day. And their view was, how can we make structured products more transparent? How can we air out any of the old hangups which exist post GFC? How can we make it digital and in line with the platform experience which the broader kind of equity trading market or brokerage platforms have created for everyday investors? And thus, Stropro was born as a digital platform or an interface where people can turn their market view into a set of binary outcomes and payoffs.
Why do you think the structured products are not as common in Australia?
I think, to be honest with you, it's mostly structural. The rules keep them wholesale, and wholesale doesn't really advertise. So, within that kind of, I guess, broad blanket statement, there is regulation by design. They have to be wholesale, or investors have to be wholesale. Retail were able to access these products, but it never really ended well. And that's mostly, I would say, due to adverse actors at different points in time. There's a distribution issue. Now you mostly get access to a structured product through an advisor. So, by virtue of not having a real retail funnel, there's no real public awareness. And then, the complexity. There is a large educational hurdle that we have to overcome, that Stropro is kind of championing in the market to bring people up to speed with the different payoffs, the different tax treatments. And to put it bluntly, it's a lot harder to explain than just buy a house or just buy an ETF. So, I think that's part of the whole equation.
Yeah, I agree. I think if people find things complex, they're usually going to stay away from it.
You can't use or speak passionately about something you don't understand.
Yeah. Okay.
Yeah.
Understanding that's a good one. So if you had to explain what a structured product is in simple terms, how would you explain it?
Mate, super simple. A structured product is a rules-based investment. Upfront from inception, depending on how you configure the structured product, what happens in each market scenario, up, down, or sideways. And because the payoff is written into the contract, there is no ambiguity or gray area. It's, really just left to how the underlying asset you've tied it to performs based on the rules you defined.
Obviously, within the structured products as well, there's a few different segments. There's
Mate, how
protected
long is
equity
a
loans.
string?
One I'm obviously interested about, we've had a chat about
Yeah.
this as well, is the protected equity loans. I'm keen for you to try to explain that also in simple terms.
Yeah, awesome. So a protected equity loan is effectively market exposure to a basket of stocks or ETFs, your choice, whether that's listed locally or globally. You've got a bit of flexibility there. And that market exposure is funded via a limited recourse loan. So when we put on the market exposure, at the same time as we make the trade, we buy a put option or protection equivalent to your market exposure. And what that effectively does is limits all of your downside because that put option gives you the right to sell your position at a predetermined price. So it doesn't matter if the market falls, you've always got that insurance policy, that put option that you can exercise, which covers your downside. Now, your upside could be unlimited or capped. So holistically, market exposure to a basket of your choice, protection over the market exposure. The market exposure and the protection is funded via a loan. The investor pays the interest and the protection cost as one upfront outlay, and that outlay is deductible up to a predetermined RBA benchmark rate.
So if we compare that to a property. You go in with a property, you get a loan from the bank, you can technically lose more than what you put in, right? You can sell at a market downturn, the property market decreased by 30%. You're telling me that these products have a stop period of where you can't lose more than what you put in.
You're exactly right. It's defined, your downside is defined from day one. So the property comparison is a really good one. It helps people understand leverage. It's most people's first experience with leverage. And I wouldn't say that they're competitors, they're just different tools. Property is a long hold, income producing, tangible asset with real forced sale risk. As you said, if the market does, downturn and there's some capitulation or you're unable to meet your servicing, your cards and your choices are very limited. Protected equity loan is similar but different in the sense that there is a defined term, there is some capital protection over the leverage exposure, and there is a defined window of investment exposure with no servicing pressure. So, it's a complement, not a replacement, and they're quite different in that sense. And that doesn't even begin to consider kind of the actual reality of managing an investment property and all the complexity that comes with real human people, So they're different, but the leverage effect is similar. We should walk through, an easy example just with some real life figures. So why don't we just walk through an example on, say, $100,000 loan, and that $100,000 loan buys you a basket of stocks of your choice. That loan and the insurance over that loan, over the basket of stocks, has an interest cost, which might be anywhere from, say, 9% through to 18%, depending on the volatility and the insurance policy cost underneath. So on a 100K example at a 9% interest cost, you'll be looking at a $9,000 outlay. But for that $9,000 outlay, you control 100K of market exposure and you get all upside participation on that exposure. So if the basket ends at 130K or 30% gain, you'd repay the loan of 100 grand and you'd keep the 30K gain, knowing that you spent 9K. So your profit in that example would be about 21,000 or 21K. Obviously, that 9% outlay, depending on where the RBA benchmark rule rate is and what the rules are at the time, that outlay could be a deductible interest expense, very similar to what your negative gearing was with property. So, the current rate is 10.35%. If you spend 9, you'd be able to claim that 9 when you fill out your tax return and get a credit or refund depending on your tax bracket and circumstances. So, that exposure might actually be more like, $5 grand for that 100,000 worth of exposure after considering your tax position. Then you might have dividends which could flow through, franking credit benefits, and lastly, obviously, the capital performance or the capital appreciation of the underlying exposure. Does that all make sense?
That makes sense. It does.
Yeah.
100%. It's I like to compare it to property because I think that's what most Australians know, especially when, as you said, using leverage. The comparison to the property market as well is you don't need serviceability. So to me, it stacks up quite favorably against property, right? There's a lot of things that are in favor, right? The equity recourse loan, where you can't lose more than you put in. There's no margin calls, like on the NAB equity builder, for example.
Yes.
Plus, you don't need serviceability. How do you think it does stack up against property?
Look, good question. I think for a long-term wealth building vehicle, if you can capture, what's the long-term market average in the S&P 500, for example? 10%, give or take, 12%. Yeah, exactly. So I think if you take a long-term view and you don't view PELs in isolation as a one-off, 1 year into in vehicle, you take the same 30-year time horizon which you have in property, and then you apply this product, taking it year on and year out, compounding your equity position while your loan value stays the same on an annual basis. You start to see that power of compounding, and at 10% or 12% per year, within 7 years, you've doubled your, leveraged capital position from, say, $1 million to $2 million. With that 90K outlay every single year, half of which you may have got back as a tax refund or credit. So I think if you view that over multiple cycles where you're able to capture that long-term historical average and you do repeat it, rain, hail or shine, which is the key, I think that you'll end up in a tremendous position. And personally, that's how I'm using it as a wealth accumulator. I think that homes ultimately, they give you a place to shelter and satisfy some of your basic needs. And I think it could be viewed quite differently from, say, your primary place of residence versus an investment property versus a PEL. And ultimately, I would like to have, a hat in the ring, so to speak, with all of these different investment vehicles from a diversification lens. As a young person where property prices have kind of soared in recent times, a PEL is a great vehicle. And I'm just going to start and continue to grow. The same, opposite end of the spectrum, I have people who are very much overweight property, who are clients, who need the diversification. All of their wealth is in property, which is subject to those ebbs and flows of market cycles. As you said, if you have a downturn, you could really get caught off guard. A protected equity loan allows them to have this exposure holistically in their portfolio and start to balance things out without the same opportunity cost of tying up capital. It's just much, much more efficient.
Yeah, okay, that's good. Do you think if more people knew about these products, they would tailor out of properties and invest in these?
I think so. I think there's an information asymmetry there. I don't think that everyone knows about them. I don't think a lot of people have had access to them. They've been around through multiple different cycles, and they perform best when there is a mixture of, relatively elevated interest rates like the current environment that we're in, and then picking stocks which might be out of love with the market, but are still fundamentally sound businesses, and stocks that produce a good dividend. The flip side of that is taking a purely growth view, which some investors do, and transparently, when it works out phenomenally well due to the leverage. So, yeah.
Where do you think these products land post-budget?
Structured products specifically in a post-tax reform environment, obviously there's going to be more of a tilt towards income and the certainty that some of the income-producing structured products can provide, especially with a lot of the market downside protection that can be used. With PELs specifically, again, I like to go back to the never sell kind of accumulator type approach where you take it year on year, and at the end of the term, you're not triggering a CGT event by selling any surplus equity that's required to pay down the loan. In fact, you just bank that into your brokerage account. So if at the start of the term, your $1 million worth of exposure bought you 1,000 shares, those 1,000 shares go up 10% in price, you might only need to pay back, 900 shares worth of exposure, and the remaining 10% or whatever it might be, bearing in mind the system loose maths, that gets delivered to your account to continue to compound. Take on the strategy year on year, you haven't triggered a CGT event, and you're able to accumulate. I mean, long term, whether or not these changes will be revoked is another question. But there are many different ways to manage those CGT implications over the long run. So at Stropro, we view kind of this broader reform as a massive tailwind.
How do the investment banks and you actually make money on these products?
This is something which everyone always wants to know because they can raise red flags and it seems too good to be true. But the real interesting thing with structured notes is that the issuer or the investment bank, whether that's a Goldman Sachs, a Macquarie, a JP Morgan, a Marex, whoever that might be, they're actually hedging the payoff in the options market. They're not betting against you. They're running a book and earning a spread. So the bank isn't your counterparty or your competitor in a poker sense or in, an us versus them market sense. They're merely hedging out the risks and making a margin on the structure. So interestingly, with structured products, your return doesn't come from someone at the table losing. And they make a margin, as I said, on the hedge. We make a sales credit on the hedge as well. Everything's embedded into the unit economics of the product. So as an investor, you don't necessarily feel or pay for it out of pocket like you might a placement fee or a management fee. So when you do take on one of these strategies and you see a headline rate of, say, 11% per annum, That's net of all fees. There's nothing hidden. There's no funky things going on in the background. You're not going to get hit with a 70 basis point ongoing fee. It's very clean and clear and upfront.
What's the typical interest rate on the leveraged instruments? What are you usually getting percentage-wise?
So with the protected equity loans, there's a lot of flexibility in terms of how we can structure things and how we can massage that rate to be at the level you desire. Typically, for something like the VAS, broad-based ASX 300 wide market exposure, you're looking at the high nines, 9.5% per $1 million worth of exposure. If you introduce a little bit of AAA, which is a cash ETF that is kind of like a liquid term deposit in a sense, that interest rate might come down because you don't necessarily have to buy the insurance or the protection over the cash component. At the flip side, if you take a very volatile name, an aggressive name, something which flies around a lot, like Tesla, or of late BHP, maybe a semi-stock, that interest rate might be higher to closer towards 18 or 19% per annum. The way to think about those interest rates, the cost is a measure of the volatility, or a reflection of the volatility. If it's more volatile, there's more risk, which makes it more expensive to hedge. But the flip side of that is if it's more volatile, it's got a higher potential or a chance to move for or against you.
You touched on the wholesale aspect to it.
Yeah.
You got to talk me through what a wholesale investor is, but then also, are these becoming available to retail investors?
So wholesale investor is basically the S708 test, which broadly means or asks, does this investor have 2.5 mil net assets or 250K in income over 2 consecutive years? And, that test, some people challenge it sometimes. Some people are quite dubious of the test because the reality is a lot of Australian investors now meet those requirements, but don't necessarily have the sophistication of a high net worth or, very qualified investor. That said, it does kind of start to provide some guardrails as to who can and cannot invest in these products. Retail-wise, there have been multiple, I guess you would say, cycles for structured products, and they have been available to retail clients in the past. But our position is that they should be used solely for wholesale investors. Some mass market them and do make them accessible. I can see the merit, absolutely. Especially when you have a very diligent, qualified advisor like yourself, who is really trying to differentiate themselves and produce differentiated outcomes for clients. I can see a case for it for retail, but perhaps there need to be more guardrails, more questionnaires, demonstrated understanding of the risks, rewards, and what's really going on under the hood, so that everybody can have comfort when using these instruments.
How do people find more about you and more about Stropro and investment structured products?
So you can visit Stropro.com, where we've got a growing website with a bunch of different articles, a bunch of different insights, case studies, educational materials and whatnot. You can also book a meeting with me. Happy as to support any conversations around structured products, answer any questions, and really, at the end of the day, our role is to help you express a market view and bring you up to speed on what is possible in this realm. If you think rules-based investing and defined outcomes or payoffs, depending on different situations and the market is for you, then absolutely touch base and let's see what we can do.